All right, guys. This is going to be long, but hopefully it's educational. Going over OPEX, windows of strength, windows of weakness, talking about the underlying Greeks of Vanna and Charm because these are the most important, obviously besides Delta, but the most important ones during these windows, and how I tie this into my trading, right? You guys will notice that during windows of strength, I'm more aggressively looking for longs, right? Especially if we're currently trending. And I tie this in with a lot of other things, primarily accumulation patterns. I will be looking in windows of strength to be adding long, especially on pullbacks or breaking bases of key levels. And then during windows of weakness, I'll either be kind of sitting on my hands waiting for pullbacks, or if we're in active distributions during these windows of weakness, I'll be looking for shorts, right? And I kind of use them interchangeably to determine what I want to do based on the schematics, right? And then using data to kind of follow suit with those. So very interesting, but kind of just starting with the bread and butter. What are Vanna and Charm, right? So, like I said, secondhand Greeks, a lot of these are primarily based on the function of delta, but also based on IV and theta decay, right? So, those are the most important things. To start with Vanna, right, it just measures how an option's delta, right? So, every dollar that the underlying moves, that's going to be your delta. Changes with shifts in implied volatility. So when IV decreases, right, the delta on out of the money options, right, calls or puts, tends to move or shift towards zero. So when it does that, it prompts market makers or dealers to adjust their hedges. So a good example of this would be if dealers are short puts, right, on SPY or SPX, and any drop in IV would reduce their delta exposure. And when that ends up happening, when we see the drop in IV, this leads to them having to buy back the underlying, so buying the actual shares of SPX or SPY to rebalance, which puts support, or I guess puts upward pressure, or supports price to the upside, right? And conversely, if you think about it the opposite way, right? If IV starts to rise, this increases the delta, and this requires dealer to then sell, which exerts downward pressure. Okay? If you guys need to take notes on that, go ahead and rewind it, whatever you need to do. Now, the second aspect of this would be charm, right? If we're talking about charm, this is kind of like delta bleeding, if you will. This measures how an option's delta changes as time expiration decreases, right? So as time goes on, this affects essentially the underlying just simply from charm, right? This I always talk about. There's a time crunch that's going on. So as out of the money options approach expiration, we're getting closer and closer to it. Their delta erodes closer to zero, right? So they're losing value. And this reduces the need for dealers to maintain any hedges. So another example of this would be dealers are short out of the money puts. They have to buy back their positions every day, right, as the delta decays closer to zero, and this creates a supportive buying flow for the overall market. And this is the strongest as we lead up into OPEX, primarily T plus 2. You guys will notice as we get closer to the OPEX, right, usually those 2 days, let's say OPEX is Friday, Wednesday, Thursday, Friday, or Thursday, Friday primarily, I'm looking for SPX trades. There's a reason I do that. So just to kind of I guess give like a quick little synopsis of it. Vanna and Charm create liquidity flows for the overall market, especially around OPEX. And this is due to the massive volume of options contracts or hedging that dealers are looking to de-risk against to be delta neutral, whether it's short puts or long calls, whatever it may be, right? This is creating a massive influx of buying equity or selling equity, right? So this is primarily one we want to be trading, especially as options traders. It's going to give good movement, and that's really what we're looking for, right? Big movement in a little amount of time. So let's talk about how this ties into the windows, right? We'll start with the 2-week window of strength pre-OPEX, what happens, why it happens, and then I'll kind of overlay that on the chart here. Okay, the 2-week window of strength, right? So in the 2 weeks leading up to the monthly OPEX, if you guys don't know, it's the third Friday of each month. SPY or SPX experiences a tailwind, like I said, of upward price movement. Sometimes people describe it as the slow grind higher or the stair step up, and this is driven essentially by Vanna and Charm, right? Which intensifies as we get closer to the expiration. So you guys will note, this is why I use Think or Swim, right? And then you can throw it on here really easily. These are each OPEX kind of expirations here on these red lines. So OPEX is obviously here, and then the 2 weeks leading into that are usually supported by Vanna and Charm. So very, very simple. Once we hit the 2 week, or once we hit OPEX, we typically get a decline or some kind of consolidation. And right, we can kind of see that over and over and over again. We end up kind of moving into the OPEX here. Obviously, 2 weeks leading into that, we ended up kind of finding a bottom. We had a rally, pulls, obviously consolidates here. OPEX ends up happening. We do get a gap up, start to sell, right? We get a big low, another big low, right? And then obviously we go into the 2 week window once again at the beginning of the month at 4.4, 4.7, right? Big rally up, pullback, OPEX, and now we have an opportunity to once again either see mitigation or see potential weakness. And then from there, beginning of the month will end up happening right around May 1st, right? And then we have a 2 week support leading into the OPEX again, right? Very, very simple here. Now, Vixpiration, if you guys don't know, I had people ask me about this one, occurs on the Wednesday before OPEX, okay? And this marks the expiration of VIX futures and options. And this is important because it does amplify the flows, and volatility-related hedges are typically unwound or sold off, right, to kind of help with the hedging, right, to be delta neutral. And this contributes a lot to the stability or the upward bias. Once VIX ends up expiring, we'll either kind of be stable or pinned to a certain gamma level, right? I always talk about that. This week was 529, or it will help kind of create upward pressure. And why this ends up happening, guys, why do we have this 2 week window? It's essentially charm-driven buying. So as out-of-the-money options, mainly puts, though, it's the big thing. Approach expiration. Remember, you have to think, right? This is a lot of puts, kind of, I don't want to say put saturated, but a lot of the reason that this moves up is because people are hedging equities, right? People are buying shares. People are innately bullish on the market. That's just how it is. The market's always gone up. People want it to go up to increase value. So people hedge with puts. People hedge with volatility instruments like VIX, VXX, whatever it may be, UVXY, right? So people will be buying puts, and as those start to decay, or they're not seeing movement, or time decays them, whatever it may be, IV comes down, right, and they start to lose value, those will start to be unwound, right, and that results in upward pressure. So going back to that, right, as these approach expiration, their delta decreases due to charm, right? Charm is the time sensitivity leading into the OPEX. Dealers who sold these puts reduce their position by buying back equity, right? And this is created consistent pressure on SPY, SPX, QQQ, whatever, and this ends up having a stronger dated move, or a stronger move leading into shorter dated options. And this is more prevalent around OPEX, right? We start to see larger moves as those are unwound. So easy example, I guess, would be like if a dealer short 100 shares to hedge an out-of-the-money put, right? Because you have to have 100 shares to sell a put into the market like that, right? Because each contract, if you guys don't know, is the equivalent of 100 shares. And that's expiring, let's say, in 5 days. Each day reduces the delta, and this allows them to buy back the shares, which then supports the market. Okay. Now moving to Vanna, right? So Vanna, under normal conditions, the IV term structure is essentially like upward sloping, right? IV is consistently supposed to be going up. So if IV decreases as options kind of approach expiration, the decline in IV reduces the delta of those out of the money options, whether they're calls or puts, and this prompts dealers to buy back SPX, SPY, QQQ futures, whatever it may be, to adjust their hedges once again. This once again has like a hopefully you guys can catch it. It's like a feedback loop, right? Where we start to see a positive loop where people are buying as IV's falling, and then this leads to more buying, and this can kind of give you those big massive moves as we see usually like in the last hour or the days leading up to it. And this is a big move in terms of volatility to support stock prices. So, right, I would say like dealers often long gamma on out of the money calls, and they short puts. So whenever they sell SPX as the index rises, they usually buy back those calls when it starts to fall, right? And we'll see this start to stabilize the market and kind of create it, combined with Vanna charm, this creates like a net bias towards the long side, right? So, as things, I always look at like flow, right? If we start to see a ton of like flow coming in on days like this where we're really consolidating and it's really heavy put bias leading into an OPEX, usually that's selling of puts. They're accumulating the shares, right? And then what we're likely seeing are smaller positions that are being tied to this via call side, right? And I don't really ever follow the big puts whenever we're consolidating like this in these windows of strength. They're usually hedges, right? And they're selling those to the market, buying back equity, right? And people get this so confused. So I never pay attention to that because those are usually just hedges from market makers. Um, Another big thing too that a lot of people don't really think about, like at the beginning of the month, right when we see the window of strength, I'm gonna ask this, and hopefully you guys can answer it in like the brief second. I'm gonna pause. What usually happens at the beginning of the month? Does anybody know? Like beginning of the month, like obviously we're going into a window of strength, but what ends up happening from like an institutional or like a passive fund perspective? Hopefully people know. Okay. So, beginning of the month, there's payroll deductions that feed into 401ks, feed into pensions. So, there's a lot of money that's being injected from really big entities into the market that are buying up a lot of, I guess, individual assets as well as the ETFs. And this passive buying also supports the market, right? So, pretty simple here. And that also has to be counteracted by market makers also hedging, right? So, usually buying more calls, selling puts into the market, buying shares for hedging, and this also reinforces and contributes to that feedback loop as well. So that's pretty much the gist of it. We can talk about the window of weakness now. So after OPEX and after expiration, Vanna charm tend to expire. So as options contracts are settled or closed, this creates a 1 to 2 week. It can be one, right? We don't really know the exact time frame of it because sometimes it leads into the beginning of the month, like within a week or so. Where SPX or SPY or whatever is a little bit more vulnerable to macro flows, fundamentals, large catalysts like geopolitical news, things like that, that can really create higher volatility or downside pressure since there's no supportive flow or buyback loop that's going to be really supporting price or preventing it from going lower. So why this happens, right? Post OPEX, Gamma, Vanna, Charm all disappear as options expire. So dealers no longer need to adjust hedges, and this removes, as I said, buying support that stabilized or lifted the markets or just kind of pinned it to a specific level. Like I said, it becomes way more susceptible to everything else. So this usually starts after expiration. Flows will start to kind of progressively fade once like the OPEX ends up kind of happening, whatever Friday that would be. The market essentially loses its tailwind, and yeah, that opens up a little window leading into the end of the month, right? Like I said though, during OPEX, you guys kind of saw it this week, right? So I don't have it marked, but I said 529 was a massive gamma level. We couldn't really get above that, right? So you'll notice, like during OPEX, right? If you aren't getting a major breakout, what will end up happening is stocks will pin to specific strike prices that have the highest gamma or the highest open interest due to the hedging adjustments, which create temporary stability, right? So there's kind of uncertainty in the market right now with a lot of the tariff stuff going on. I feel like there's a lot of back and forth, back and forth, back and forth. So instead of having just a straight breakout, sometimes what you'll get is stability, right? It'll just kind of hold at these levels or pin to a specific price strike as they can hedge against that level or de-risk against that level. So after OPEX, these imbalances usually resolve themselves and the market moves a lot more freely. But as I said, right, this can often kind of result in downward pressure if bearish sentiment or bearish flow or, like I said, a lot of these news catalysts start to dominate the tape. Okay, so pretty simple on that one. We could talk about like the absence of liquidity, right? That's another thing too, like just lack of liquidity during these windows. A lot of people kind of know about this, I would say, but also I talked about the passive funds buying at the beginning of the month or buying into these windows of strength. I think that's kind of irrelevant right now because we are seeing a lot of volatility, as you guys know, with a lot of the stuff going on in the news. So I don't really think that's super relevant right now. But yeah, that's essentially really what it is, guys. It's not super crazy. right? I talked about, a lot of different things, but you guys should know, right? The big thing to look at in these windows is looking at IV as well, right? If we see increasing IV or decreasing IV, you guys have to know, right? If we're leading into an OPEX, we see rising IV, which increases put deltas. This can obviously kind of force dealers to begin to sell more. If we see decreasing IV, right, on a lot of these strikes leading into that OPEX, we can assume, especially if the chart looks good, right? We're in an accumulation or a distribution, you're going to have to tie that into it. But if we start to see decreasing IV, right, we can start to look at some of these higher gamma levels. We can start to look at like gaps. We can start looking at easy targets and obviously tie structure into this. And we can determine if we're going to get a delta buyback, or we can see, that feedback loop to push it higher, or we can see some weakness leading into the OPEX. So that's really all I really want to cover. I don't really have anything else on that. We can talk and look at some charts really quickly, but I guess to kind of do like a little conclusion of it, 2 week window of strength before OPEX, guys, is driven by Vanna charm. You guys will see me talking about that. Where falling IV and time decay reduce options deltas, right? This prompts dealers to buy futures or SPX, SPY, ETFs, whatever, and this creates a supportive tailwind or flow support leading into that. Post OPEX, these flows are gone, right? This opens a window of weakness where the market is more vulnerable to volatility or downside from whatever, right? Could be tariffs, it could be any kind of catalyst that's news driven. Usually we can see this in the chart prior, so that's why it's important not to follow headlines. VIX expiration is on that Wednesday leading into OPEX, right? And this amplifies the dynamics by unwinding the volatility hedges. So under the hood, it's all about dealer hedging. Massive SPX options and flows from Vanna Charm usually dominate the price action. It's not anything else, right? It's not the headlines. It's not anything like that. It's usually those three that are kind of all mixed together. So that's all it is. That's all I wanted to talk about, just to kind of grab that really quickly. I can show you guys some graphs, and then we can obviously cover the chart here really quickly and kind of look at some historical action. But I just wanted to cover that really quickly and how that ties into my thinking leading into these windows of strength, leading into the windows of weakness, and how I kind of pick and choose the little pockets that I want to trade in based on the flows, but also based on the schematic of the charts. Here's a simple visual representation. This is very general. Obviously, this will have a little bit of a different feel and look as you get closer to high volatility events, right? So a good example would be this May coming up. OPEX is on the 16th. The week prior, we have FOMC, right? So you have to naturally think that there's going to be a lot more hedging that occurs there, so a lot more deterioration from a IV or volatility perspective. There's going to be a lot more pressure on those hedges, whether they're puts. Or I shouldn't say whether, it is going to be puts. And if we can get a big move leading into the FOMC, or if it's a muted reaction, and then you can use your gamma levels, right, or kind of understanding what the bigger targets are at, right, in terms of open interest on strikes and what could potentially be a magnet leading into that OPEX, right? Now, looking at this, it's pretty cut and dry. You guys can see total buying pressure in this 14-day window, right? If you guys look on the x-axis here, this is the 14-day window, or pretty much buying pressure falls off a cliff, right? Or it subsides pretty dramatically. You guys will see Charm and Vanna will decrease as well, but they start to kind of flatline about a week before OPEX, right? So the week before is when you'll naturally start to see these start to flatline out. Primarily Charm, right? It's kind of being tapered down because it's a time sensitivity, so theta is going to play a big role here. But the big one that you'll note is going to be Vixpiration tied into Vanna, right? So Vanna is derived essentially entirely from IV. So you're going into a volatility expiration with your biggest secondhand Greek being tied directly to Vanna. You will see a big drop in that, but from there, does IV increase or decrease following Vixpiration? And then you can use that to really gauge if it's going to be an upside move or a downside move, right? And tie this in nicely with the supported flow from buying pressure that should kind of accommodate that on that same day. This is why I really start to look for SPX positions right around Vixpiration on that Wednesday going into Thursday, looking at it Friday, right? There's a good opportunity that you can find on these. especially around quarterly OPEXs. I talk about this all the time. Not all OPEXs are the same. So quarterlies, they can't roll, right? So they can't roll it to the following OPEX. That one has to be closed out, and all hedging has to be finalized there. Whereas like an April or like I'm trying to think like a March, right? I think March was quarterly, so no, we couldn't do that one. So April's a good example where it can't be rolled. So you don't really get the biggest reactions off of those. It would be, June would be a good example. So yeah, you wouldn't get the best reactions off of non-quarterly. Quarterly are the biggest one, and then obviously the biggest one would be end of year. Okay, so kind of the leap expirations are the biggest ones there. But get a little visual representation here. Now we can jump back into some of the charts that we were looking at, right? So if we take a look here, I always have these overlaid on. It's very simple. If you use Thinkorswim, you can literally go here, go to time axis, and it's just show expiration Friday. This will mark out every single OPEX. You just have to note that the Wednesday prior to the OPEX is going to be your expiration, so you have to manually mark that out. But pretty simple, right? I mean, you guys can take a look. If we go back to here, we obviously knew that this was a distribution, so you can kind of keep that in the back of your mind and target this lower gap here, or you guys could have been looking for the gap that was hidden down here, right? So using this, we can see 2-week window, right? So we have an OPEX, we have a 2-week window of weakness here. We end up chopping, going sideways. We end up having a drop, right, going into the end of the month. So right around, a little under 14 days, we end up consolidating. We end up having the beginning of the month. New flows come in right into that 14-day window of strength. Big gap up, right? And then we end up consolidating here, expiration. We end up dropping into the OPEX, kind of close here, beginning of the month, or not the beginning of the month, but OPEX passes. We end up consolidating. We don't make a new low. We end up pressing higher. 14 days of I guess strength would have been here, but this is why it's important, right? We don't make a new high. I remember I noted this. This actually is a Vanna squeeze to the downside because you're not getting a new high, but what you're getting is a IV increasing, right, without price moving higher. So you can actually have a Vanna squeeze to the downside. I have it in my chat. I know I ended up calling this out, but we ended up getting a big drop here. We end up breaking down, leading into the OPEX, especially on Vixpiration. Big move on Vixpiration here on 1218. OPEX ends up happening. We get a pop back up. We can't make a new high. Beginning of the month we're in a 2-week window of weakness. We end up dropping. We end up pushing back up. We should have gotten a strong beginning of the month. We end up dropping one more time for a new low. We're still in the 14 days of strength. We end up catching a bottom. We end up grinding up higher into our OPEX. Post OPEX, we have a little bit of a move here. We end up dropping again. We're in our 2-week window. We can't really make a new high. As you guys can see, we're just basically filling gaps here at this point, right? Filling gaps and then breaking back down. Then we end up beginning the new month here on February now, right? Stays pretty strong. We're in our 2-week window. We end up breaking and making a new high, but not a very valid new high, right? And this kind of ties into our UTAD, right? So we have supportive flows. We end up making a new high. We're leading into an OPEX, but it's not a very large new high, right? So we're seeing a deterioration from not only a higher IV, but we're also seeing, really a lot of different factors that are playing into this for a continued downside. So we end up finally breaking down. OPEX ends up occurring, right? So now we're in our 2-week window of non-strength. Pretty much a straight grind down. We do have a couple days here where we end up bouncing at the beginning of the month during our window of strength, but for the most part, it's really nothing burger. We're playing out our distribution with just kind of pops where they were fadeable, so you could have used those windows of strength to say, hey, this is catching here, right, in this 2-week window, but very weak bid, and you can pretty much fade every pop that you saw on this, right? And then it ended up breaking down. We kind of caught a little bit lower, right, than we would have liked. If you guys, I think QQQ would have been the better chart for this one. Let's see, I might have it on my other one. Actually, no, there's no way I charted back here. But yeah, you guys can see it kind of comes down into this spot here. We end up going into our 2-week window of strength leading into OPEX. We do catch a bid here. We end up kind of holding. We get a gap up. Once again, still technically a lower high. OPEX ends up happening. Go into our 2-week window of weakness. We break down. We double bottom. We end up pushing up into the beginning of the month. And this is where I kind of got a little bit worried, right? Because we were looking to really buy on April 7th. If you guys remember, that's when the 2 week window of strength kind of kicked in. And I was looking for a double, or I guess like a sweep of these daily lows here. If you guys remember, because we had daily equal lows, we knew accumulation was likely playing out by the asks being put it higher, or placed higher. I don't know why I said put it higher. But yeah, we ended up kind of having this push here. We had our terminal shakeout bar, right, which was 4.3. 4.4, we ended up having our capitulation where VIX ended up spiking. And then here on 4.7, new flows come back in. We have our 2 week window of strength, and we ended up having a big, big pop, a big squeeze, right? Now it's kind of up to whatever happens, right? We're now going into our window of weakness until I think it's what, beginning of May. So somewhere down here we could sell back down, right? Or ideally we just kind of chop. That would be the preferred thing, is if we end up just kind of chopping here against this progression gap, and we just have a slow grind higher into our window of strength, and maybe like a pullback and then a big rip all the way up, right? Leading into our window of strength. That's kind of what I'm hoping for, but I would encourage you guys to go back and take a look at this and kind of build your own little layout on how you would like to trade around the windows, because it is pretty nice, I will say. It kind of keeps you disciplined. And obviously, if you have like a system built around that as well, with trading accumulations or distributions or trading into the whatever you guys end up doing, this also just kind of prevents you from being in the casino at all times and being able to sit back, take a look into these windows of strength. Is it true strength? Is it kind of weakness, or like a weak push in these windows of strength that you can short fading into an OPEX? There's a lot of different ways that you can play around it. But yeah, just wanted to kind of get this out there really quickly, because a lot of people have been asking me. But yeah, I think this is a pretty nice little system here, and I've been using it for a while now. So yeah, if you guys have any further questions, feel free to ask me. There's no way I could cover this in one video, so I just wanted to kind of put it out there, give you guys the data, kind of what it is, why it ends up happening, and giving you guys like an opportunity to overlay it on a chart and then see how you can apply that to your own trading system. So if you guys have any questions, feel free to shoot me a message and I will answer, but hopefully this helps.